What's the right way to look at long-term returns in the S&P 500? That's what I'm thinking. In a recent episode, I had used a chart that showed historical returns of the S&P 500, and we were talking about how, at least in the last year or three, let's say, that we haven't seen a downturn in the market on a relative basis. And I wanted to pull back those charts because we used two different kinds of charts. I think it's really interesting and useful as we think about what's going on in the stock market and maybe how we might think about it in the future. So the first one, there we got red and black lines on here. So the black line is important to take a look at. That's the S&P 500 based on price. So when people talk about how the index has worked, what the S&P 500 index is at, it's that number that's right there. And you can see that it's returned something like 8% over the, that's the last, 20 or 30 years, I guess now, 35 years. You can see in that bar on the top right. I mean, these numbers go back to the early 1900s and even into the 1800s when you look at some of that data, right? So that's accurate. So when we look at what did the S&P do? That's what we're talking about. But that red chart line on the chart here, that includes the price increases plus dividends, right? The black one just is the price increase. And you can see where the dividends come in, right? At about 2% over that time period. So on a long-term basis, the S&P has averaged something like 10% all in. Like our investment return is something in that 10% range. But importantly, take a look at that. The dividend component is about 20% of our investor return, right? So we look at what did the index do over time. That ignores something like 20% of what we see as investors. So there's an interesting thing to think about when you hear people talking about or prognosticators talking about what the market does that may not tell us the whole story about what we should be looking at from an investor standpoint. One takeaway is how important dividends are in the overall picture. And this is not, hey, let's buy dividend paying stocks and all those sorts of things. There can be a place for that, but this is just buying the S&P 500, right? We get that baked in. This chart here, again, I showed it in that recent episode, but this logarithmic scale, rather than the hyperbolic, that kind of evens out some of those distortions on things, right? And this is where we can take a look at what the S&P has done, going back again 35 or so years here, but we're on a relative basis that it's off kilter, right? This really tells more of the story about, where are we right now? As we talked about recently, hey, we seem to be at a pretty high point. It certainly has been higher than that long-term average, right? Look back into the 1990s, right? Was, much higher than that, but it does look like things are expensive. So it's just interesting that, how we can look at those things, how statistics can tell different stories. A logarithmic scale on the historical returns is really a better way to look at that. And again, we're still talking about dividends accounting for about 20% of real life returns. So include that in your thinking as you hear some of these stories, hear what's going on in the market and in the economy. That's what I'm thinking. I'm always interested in knowing what you think about these things. Is that new information to you about how significant those dividends are? Is that logarithmic versus hyperbolic scale? Is that something that's intuitive, or is that something that's new information? Drop a comment in the comment box. Let's have a conversation. And as always, thanks for watching.